Hi, welcome to Introduction to MBA Finance. My name is Manjit Bryant. Please, you can find me on LinkedIn. Just look me up. A little bit about myself, just to remind you, I've been teaching and training for over 12 years. By trade, I'm a qualified accountant. I'm a member of the Chartered Institute of Management Accountants, CIMA, and CGMA. I also have a master's in financial management, and for about 4 years of that, I was university lecturer for the University of Wales, Trinity St. David. So welcome to our introduction to finance. Okay, I'll be using these slides. These slides are from taken from the book Financial Management for Decision Makers, and that's by Peter Attrell. So I do recommend that book. It's actually quite good. And so what we can do as an introduction, we're looking at the world of financial management. So learning outcomes, you should be able to discuss the role of the finance function within a business, identify and discuss possible objectives for a business, and explain the advantages of the shareholder wealth maximization objective, explain how risk, ethical considerations, and the needs of other stakeholders influence the pursuit of shareholder wealth maximization, and describe the agency problem and explain how it may be managed. So when you look at an organization, each organization has different functions. We have a HR department, a marketing department, admin department, and really at the center of that we need a finance department, because money and love money and love is what makes the world goes round. So yeah, love is good, but money helps us to swing things around. So the role of managers. So in any organization, a manager is there to make decisions, to manage. And there's three parts to the role of managers. We have strategic management, risk management, and operations management. So strategic management is what I would consider to be senior management, where they direct and lead for the future of the organization. Operations management is more kind of day-to-day running the organization. And risk management is obviously incorporating the factor of risk, so that one, we thrive in our situations, and also that we manage the risk within the organization, that we can defend ourselves against potential problems. The task of the finance function. So if we take finance function, we deal with financial planning. We deal with financing and capital market operations. We deal with financial control, and we deal with investment project appraisal. So the finance function is responsible for setting the financial accounts. So we have a balance sheet, we have a profit and loss, and we have a cash flow statement. These are the three main statements, and there's a couple other statements as well that we have as part of the account. They're the three main ones that they deal with. Finance function also responsible for budgeting and forecasting and looking at how we are progressing. So when we look at this idea of financial planning, really it's talking about this idea of budgeting. It's talking about this idea of looking to the future and forecasting. And then we look at financial control. It's comparing our performance to our actual results and making adjustments, or helping management to make adjustments. We're also involved in financing, sourcing financing for our work, our day-to-day work, our longer-term strategic plans, and also our projects. And we're involved in investment project appraisals. In other words, when organizations have to make a decision on which project to go with, or which business investment to go with, then we help with the numbers. Okay, so they're the main functions. So primary objective then of a business is shareholder wealth maximization. Obviously, it depends what kind of organization we are. That in essence primarily relates to a commercial enterprise, private sector enterprise. If you're working for a public sector organization, then obviously the primary objective is really more focused around providing value for money and providing return on investment really for the public interest. So prime objective of business is shareholder wealth maximization, not the same as profit maximization. So wealth and profit not necessarily the same. And to achieve wealth maximization, the needs of other stakeholders must be considered, and high ethical standards may be needed to maximize shareholder wealth. So we have this kind of tension between profit maximization for our shareholders and this idea of wealth maximization, okay, which takes into account our stakeholders. So shareholders are typically the owners of the business, but stakeholders are everyone that has a stake in the organization, either internal or external. And when we focus our energies and efforts into stakeholders, then generally the idea is that wealth or sustainable wealth is generated for the longer term. So that's a key thing, really. Organizations in the past, like Enron really focused on shareholders driving the share price, and they ended up using unethical methods, illegal methods, fraudulent behavior to keep driving the shareholder price at the expense of their stakeholders. Whereas if you take a stakeholder approach, then you'd look after everyone, your customers, just your suppliers, your employees, everyone around you, so that once you have all those stakeholders' needs met, then your stakeholder look after your stakeholders, and the stakeholders look after your business. Shareholder wealth maximization. So shareholders are the effective owners of the business, have a residual claim and bear the risk. So if the organization were to collapse, they would have what's left over of all the business once all the liabilities are paid off. And obviously, if it all goes wrong, they bear the risk, and are incentivized to increase the residual claim through entrepreneurial activity. So obviously, shareholders are directly involved in the business. It is within their interest to drive the business forward, to grow it. And obviously, if they're just shareholders and don't manage the business at all, then they want to make sure that those managing the business are incentivized to grow the business. However, pursuit of this objective, so if we pursue this, then it may encourage excessive cost cutting. So generally what we'll do, we'll cut the costs so we can increase our profits. But the problem is sometimes we can decrease the cost at the expense of future growth or at the expense of quality. May undermine the status of other stakeholders. So if we make shareholders our priority, we may end up doing so at the expense of other stakeholders, and may encourage unethical behavior, which is what took place with companies like Enron. And even in the 2008 financial crash, many of the banks were getting greedy. They were selling mortgages to people really that couldn't afford it. So there was unethical behavior taking place at the expense of greed. Profit maximization problems then. Profit is an imprecise term. So profit, in its strictest term, so if I buy my phone for $100 and I sell it for $200, then I've made $100 profit. That's it, straight $100 profit. But then I've got depreciation, I've got all my expenses, I've got marketing costs and all those things, which I could actually end up making a loss. So profit is based upon our accounting standards, IFRS or GAAP, if you're in America. And so profit really is an accounting term, and profit for one company can be different compared to exactly similar company using different accounting rules. So I'll give an example. Let's take something like Cadbury's, who when they report on the London stock market would use IFRS, but when they report on the American stock market, they have to report under GAAP. And you actually, for the same company, same transactions, you have two different profits. Okay, so profit is an imprecise term. Profit cannot be objectively determined based upon those reasons I've given, and period of which profit should be maximized is unclear. Do we maximize profit over 6 months, 1 year, 2 years, 5 years? And profit takes no account of risk. So in other words, if we just drive everything to profit, then basically we will take actions that will ignore many factors of risk. To do that, again, I'll bring you back to Enron, which is what they did. They found, oh, you know what, this area of the business is making lots of money, which was the speculative part, and they just pursued that. The same with Royal Bank of Scotland, when they saw these financial instruments where the mortgages was making huge profits, they put a lot of energy into that without actually weighing up the risk potential. Profit takes no account of opportunity cost. So as finance people, we need to really understand what we mean by opportunity cost. So opportunity cost is this idea that a decision we make, what are the implications of that in terms of foregone monies that we could have made had we have done it. So for example, you know, I bank with Santander. I make 1/2 interest on my bank account for doing nothing. So every time I use my money on an investment, yeah, my opportunity cost would be 1.5% because I could be making 1.5% for doing absolutely nothing for zero risk. Stakeholder approach problems does not offer clear-cut objectives. So if we take into care of all our stakeholders, we don't have clear-cut objectives, increases problems of accountability, which stakeholders take priority, and raises difficult questions concerning who the stakeholders are and how they should be treated. At the end of the day, organizations need to survive, they need to make money. So you need to prioritize your stakeholders and get a balance between those stakeholders. That's a key thing. Relationship between risk and return. So clearly, for zero risk, so if I put money in my bank for zero risk, I will get a return. But obviously, the more risk that I involve myself in, then the greater the return that I'm going to expect. Framework of rules. So principles underlying the framework of rules. So we have disclosure, we have accountability, and we have fairness. And really, this is the idea of what accounting rules do with like IFRS or GAAP is to cover these things. UK corporate governance code. So in the UK, we have a number of governance codes, and the same in the US. You know, there are codes which govern really how we how organizations should undertake themselves. So aims to ensure that powers and responsibilities of directors are clearly delineated and appropriate checks and balances are in place. So as I said, each country will have their own you know, governance code, most of which is normally, you know, copied from the UK or from the American system. UK corporate governance code. So every listed company should have a board of directors. There should be a clear division of responsibilities between the chairman and the chief executive officer. Non-executive directors should challenge and help develop proposals on strategy. There should be a balance of skills, experience, independence, and knowledge. And the board should receive timely information, and appointments to the board should be the subject of rigorous, formal, and transparent procedures. And some of the key things really is that all decisions should be documented, and whether it's a bad decision or not, if it's documented, then at least it becomes transparent under investigation. All directors should submit themselves to re-election at regular intervals. Remuneration levels should be sufficient to attract, retain, and motivate directors of the appropriate quality. There should be formal and transparent procedures for developing policy on directors' remuneration. The board should present a balanced and understandable assessment of the company's position and prospects, and the board should try to ensure that a satisfactory dialogue with shareholders occurs. So you may have press releases and at least an annual AGM. Boards should use annual general meetings to communicate with investors. The board should define the company's risk appetite and tolerance, and maintain a sound risk management system. Formal and transparent arrangements for financial reporting and internal control should be in place, and the board should formally and rigorously examine its own performance each year. Here's a little chart showing the beneficial ownership of UK shares. So, the rest of the world, insurance companies. So it just shows you who's invested into the UK stock market, and most of it is actually from the rest of the world in terms of investing. Main forms of shareholder activism. So, as a shareholder, depending on how many shares you have, you can influence decisions within the organization. Again, depending on the number of shares you have. So shareholder activism then really is exercising voting rights. So as a shareholder, you have a right to exercise a vote, meeting with directors, and direct intervention in business affairs. The more shares you have, the more influence you have. If you just have, 10,000 shares and there's like 10 million shares, then you don't really have much of a say. But if you got together with lots of other people who had 10,000 shares, and then you got to, say like 1 million shares worth of influence, then you've got something, okay. And sometimes what happens is, when you have a listed company, sometimes the banks or the investment companies or the pension companies may have up to 10-15% stake in the organization, and they may team up with other financial institutions to push for a particular direction. UK Stewardship Code. So publicly disclose how they discharge their stewardship responsibilities. Have a robust policy on managing conflicts of interest in relation to stewardship, which is publicly disclosed. Monitor their investee companies. Establish clear guidelines on when and how activities will escalate in order to protect and enhance shareholder value. Be willing to act collectively with other investors where appropriate, and have a clear policy on voting and disclosure of voting activity, and report periodically on the stewardship and voting activities. Okay, so these are certain codes that all the directors and the organization should have. Okay, so that ends introduction and part 1 to financial management. So I will see you in the next video. Until then, take care.